Today I'm going to break down the exact fundamental indicators I use when deciding whether to invest in a stock or not. Now I want to be upfront about this. This may not work for everyone, and your results may not mirror mine. This method works for me. But I understand that some people prefer to analyze stocks differently, or may spend varying amounts of time on their research. Personally, I only dedicate about 10 minutes a day to this process, and it's totally possible if you're a well-oiled machine like myself. If you're serious about picking winners, understanding these indicators can make all the difference in the world, between picking an average portfolio and one that consistently outperforms the market. Alright, so let's jump in. The first thing I look at is the average volume of the stock. A high average volume tells me a stock is being actively traded, which means high liquidity. But here's the thing, I don't consider a stock if the volume is below 400,000. Think about it. If you're holding a stock that's not being traded much, you could have trouble selling it when you need to. Or worse, you might end up dealing with huge price swings. Next up, the profit margin. I'm looking for companies that are actually making money. Seems obvious, right? But here's the thing, I want a profit margin above 15%. A higher profit margin shows me that the company knows how to keep its cost under control and can generate significant profit from its revenue. If a company has small margins, it's going to be a struggle in tough times. But a profit margin above 15%, that's a company with breathing room. And that's where I want to be. Now the next thing I look at is institutional ownership. Here's why I care about this. When institutions, big players like mutual funds and pension funds are buying these shares, that's a strong signal that they have confidence in the company's future. And that big money is backing the stock that could lead to better returns down the road. For me, I won't touch a stock unless it has above 60% institutional ownership. If the big boys are in, that tells me there's a solid foundation behind this stock. It's one thing for retail investors to get excited, but for institutions to be backing it, that's a whole different ballgame. Next up, I look at the quick ratio and the current ratio. These ratios tell me how well a company can cover its short-term obligations. Essentially, can they pay their bills? The quick ratio takes current assets minus inventory and divides it by current liabilities. I want to see a quick ratio above 2. That tells me that the company has more than enough assets to handle its short-term debts without relying on inventory. Now, the current ratio is slightly more lenient, and here I'm looking for anything above 1. That means the company isn't stretched too thin in the short term. If the company's quick or current ratio are too low, that's a red flag. Next, we move on to the return on equity, ROE, and the return on assets, ROA. Both are key measures of profitability, but they look at things from different angles. The ROE tells me how efficiently a company is using shareholders' equity to generate profit. The cutoff here for me is 15% or higher. Why is this? Because I want companies that can generate strong returns on the money their investors have put in. Similarly, ROA looks at how well a company is using its assets to generate earnings. Again, I'm aiming here for 15% or more. When I see a company excelling in both ROE and ROA, I know it's making the most of both equity and assets, and that's a win for me. Then I look at another critical indicator, the quarterly earnings growth. I don't want to see a company just treading water. I'm looking for growth, aggressive growth. So I want to see quarterly earnings growth above 25%. If a company's earnings are growing at that rate, it means they're doing something right, whether that's increasing revenue, cutting costs, or expanding their market. But it's not just about earnings growth. I also want quarterly revenue growth above 25%. Revenue growth is the foundation of earnings growth, and without it, long-term sustainability is in question. Then there is the quarterly change in diluted EPS. Diluted EPS accounts for things like convertible securities and stock options, giving a more comprehensive picture of earnings. I'm looking for quarterly changes in diluted EPS above 25%, because it tells me that the company is growing its earnings even after accounting for the potential dilution of shares. If a company can grow its diluted EPS at that pace, it shows me they're not just increasing revenue, but also managing dilution effectively. Okay, so now let's get into one of my secret weapons for finding undervalued stocks. It's called the Gordon Growth Model. This model helps me calculate a stock's intrinsic value based on its expected future dividends and growth. It's a little bit more technical, but here's the gist of it. I take the company's expected forward PE ratio, then subtract the growth rate from the required rate of return. The result gives me an idea of whether a stock is overvalued or undervalued. I won't dive into all of the math right here, but trust me, this tool has saved me from overpaying for stocks that look good on paper but are actually overpriced. And lastly, there's beta. Beta tells me how volatile a stock is compared to the broader market. If a stock has a beta above 1, that means it's more volatile than the market, meaning it's likely to have larger swings. If it's below 1, the stock is more stable but may not move as much as a stock above 1. I like to look at the beta because it gives me a sense of how the stock will behave in different market conditions. High beta stocks can offer higher returns in bull markets, but they're also riskier in downturns. So there you have it, the fundamental indicators I always check when choosing a stock to invest in. These metrics help me narrow down the stocks that I really want to invest in and that have the highest potential for growth in the future. But here's the key takeaway. While all these indicators are crucial, the most important thing that you can do is to be consistent with your research and investing. There's no shortcut to picking winning stocks. You've got to dig into the numbers and make sure the company is strong from every angle. And as always, don't rely on just one indicator. Take a holistic approach and make informed decisions. Okay, so if you found this video helpful, make sure to hit that like button and subscribe. It really means a lot. Also, let me know down in the comments what fundamental indicators do you look at when picking stocks. Thanks for watching, and I'll see you in the next one.